Top 25 growth stocks in the S&P 500. Alrighty guys, let's get straight into this. So in terms of the first stocks up here, the number 25 best growth stock of this past year is a company named Cummins in the S&P 500. They've had 27% revenue growth. Tesla's the number 24. We'll speak about that in just a moment. 28% growth for Tesla. Booking Holdings, number 23 with 28% growth. United Airlines, number 22 with 28% growth. Gen Digital, 31% growth. And number 20 is Enphase Energy, 34% growth in the past 12 months. So let's go ahead and start going through these, okay? So Cummins, first off the bat, it's expected to have revenues go down 2% next year. Not something you ever want to see, a company's revenues going down, especially for the upcoming year. It's one thing if it was in the past and it's like, okay, that was our hard time, now we're moving past that. It's another thing when it's like, oh, we're about to go through a hard time, right? On top of that, EPS is also expected to go down and be in the negative for this company. When I say the negative, I just mean it's supposed to go down for the company on a year-over-year basis. Now, I also saw this just came out here in the past, let's call a week and a half. Cummins to pay a record $1.675 billion civil penalty in vehicle test cheating settlement. So this is going to be a massive kind of one-time expense for the company overall, and so that's a huge expense for a company that is the size of this company. I mean, the entire market capitalization of Cummins is just over $30 billion, so to have a nearly $2 billion penalty is massive. So overall, when it comes to Cummins, I kind of look at the stock and I say, it's not something I really want to be involved with. Not my cup of tea, okay? Tesla's next up here. Now, if you've been following the Tesla story, you know Elon Musk and the team has lowered price consistently for pretty much the past 12 to 18 months, and they're trying to take market share right now in a tougher auto environment. So for Tesla overall, the good news for the company is they are expected to get back to EPS growth in the upcoming year. So that's a situation I do like when a company is expected to get back to growth rather than they're about to go into a business of decline. That's where it definitely differs from something like a Cummins, right? Now, when it comes to Tesla, there are companies that's putting up 20% plus revenue growth expected over the coming years. If interest rates were to come down, Tesla might be able to put up better numbers in that overall. So in my opinion, Tesla's a buy at the moment. There might be better opportunities over this next 3 to 6 months if there can be even some more weakness in the stock, if they report a weak earnings, if they report margins going down more. But this one could flip at some point in 2024 and start a lot of upward momentum at some point this year, because likely they're going to trough earnings in the next 1 to 2 quarters. At least that's my opinion in regards to Tesla. The number 23 growth stock in the S&P 500 is a company named Booking Holdings. Some people might know it as Booking.com. So this one's okay. It's got expected to have about 17% EPS growth next year. 26 analysts cover this stock, by the way. Expected to have 10%-ish revenue growth. So I like that their earnings per share are expected to increase more dramatically than revenue. So I think it's an okay stock overall at a decent valuation. The only thing I would kind of worry about a little bit here is an overall travel slowdown. We have had a revenge travel last 2 years. 2022 and 2023 were kind of revenge travel years for the consumer, and we're probably going to go a little bit more into a more normalized environment. So that's something that could maybe weigh on this company, but I think it's okay. I think it's an okay buy here for bookings. Next one up here, number 22, is United Airlines. This one trades insanely cheap. It trades at a forward P under 4. It has a revenue growth of about 5% expected next year. Airlines always are going to trade extremely cheap. It's just how it is. Usually the only time you'd ever have to pay a high forward P is if you just went through a massive recession for airlines or something like that. But yeah, usually they're going to trade at, we can call it anywhere between about a 3 forward P and about 8 forward P or so. This is just how these companies usually trade, okay? Now, I think it's a fine buy. Do I think it could be a moneymaker? Sure. Do I like the airlines? Not really. Do I really want to own airlines personally? Not really. But I do think it's an okay buy out there just because it trades so dirt cheap for these sorts of companies. Number 21 is this company named Gen Digital. Now, they just did this merger, this big merger, and they're going to have much elevated debt levels. So that is something to keep in mind with this particular company. Now, looking at this company, forward P is about 10 on this one. Expected to have a 4% revenue growth for next year, so that's okay. So I think this one looks okay. Just be careful of the debt load in regards to that one. Next up here, Enphase Energy, number 20. So Enphase has entered some tough times here very recently. I mean, this company went through kind of a boom period for the last 5-10 years, and just very recently, as in the past, I would say probably 2 quarters, all of a sudden it's gotten into some trouble here. Okay. Now, for Enphase Energy, they're expected to have their EPS go down next year. And this company is expected to be at, based upon what next year's EPS is expected to be, based upon 33 analysts covering the stock, about at 25. I have a lot of question marks if they're even going to be able to come through with that number analysts do have there. Now, in terms of revenue decline, they're expected to have revenue go down about 17% for the company next year. So I think analysts are probably too high with the EPS projections in regards to Enphase, especially hearing their last conference call, kind of the problems with inventory in the channel and those sorts of things. So I think there's a potential Enphase could be an energy trap, a value trap over this next several years, especially if we get a recession in the next 24 months. That's the thing that would really add insult to injury here with Enphase if we did go through a recession in the next 24 months. But I think even regardless, I think this one could be potentially a value trap here for a bit. And the reason being is it's not trading that cheap, to be honest, and I think analysts are too high with their numbers. I think, I don't think they're doing $4 plus next year. Maybe they do, but I just don't think it's very realistic. And so that just puts this company in a really tough situation, especially with the interest rate environment being where it's at right now. The Fed is expected to lower rates at some point this year, but there's still a lot of question marks about how fast they're going to lower. And the only way usually the Federal Reserve lowers rates rapidly is if you have a major deterioration in the economy. If you have a major deterioration in the economy and unemployment, ticks up in a major way, that's gonna hurt Enphase Energy in quite a considerable fashion. So Enphase, I'm a little worried this one could be a value trap here, okay? Alrighty, next one's up here. Axon Enterprises, number 19, M&T Bank, number 18, Nextera Energy, 17, and Live Nation, number 16. Those ones are coming through with 36%, almost 37% revenue growth, 38% revenue growth, 38% revenue growth, and 40% revenue growth for these ones. Axon Enterprises, they're in with the government. That's good, and especially on the state side. They make a lot of the tasers and camera-related products for police officers and those sorts of things, and they have the big cloud business. So they have a pretty, I would say, an extremely stable revenue base for the next 10 to 20 years. So that's a good thing for this company. The bad news for this company is earnings per share is hardly expected to go up next year, only at 6% expected, trading at a forward P of 60. So you're going to pay a premium for a company like this because they have those government contracts, those state contracts that, it's like, they're gonna continue to renew and use the cloud data and all those sorts of things. But on the flip side, revenue growth is expected to be 21%. So the fact that only 6% revenue EPS growth is expected, while 21% revenue growth, that makes me a little wary, because usually that's not a very good sign. You usually want to see your earnings per share increasing more rapidly than your revenue. So this is complete opposite situation of that. So I don't know. I look at this one and I think it could be steal money for a bit. That's the best way I could put it. There's a potential that this one could be steal money for 2 to 3 years in regards to Axon there. Okay. Number 18, M&T Bank. This is one, EPS is expected to go down for them in 2024. That's not great. Trading at a forward P of about 9, which banks always trade very cheap forward P-wise. Pretty much always under 12 for the most part for banks, and a lot of times under 10. So that's to be expected. Revenue is expected to go down for this company as well. Over 5% revenues down expected in 2024. So I think this one's just kind of a waste of capital in M&T Bank, because here's the thing. If I want to own a bank, I want to own the best. The best is JP Morgan. So if I'm going to put money anywhere, I want to put my money with JP Morgan. If I had to pick something outside of JP Morgan, I'll go to Goldman Sachs. But not looking for somebody like an M&T Bank. I think that one's probably just a little bit of a waste of capital in my personal opinion. Number 17 is Nextera Energy. This one, as far as next year's numbers, expected about 8.7% EPS growth, trading at a forward P of about 17. 3.6% revenue growth expected for the company. So I think this one's okay. Not my favorite, but I think it's kind of meh, an okay stock. Live Nation. Okay, so this one's getting really interesting here. So Live Nation, you should know them as Ticketmaster and all the other, very popular websites and apps and things like that you use to maybe get tickets to a concert or maybe a live event of some kind. So here's the issue with this company, okay? 7% revenue growth expected. First off, I'm not even sure they're going to be able to put up that number next year. That's a big question mark to me. But let's say they do put up that number. I don't think it's going to be a very good sign because of what's going on with the government that we're going to get into in just a moment. 35% EPS growth is expected. I don't think they're going to put up that number. And if they do put up that number, it's going to make the government a lot more mad, which isn't going to be good. And the company's trading at a forward P of about 42 on this stock. So now also remember, we went through, just like we went through a revenge travel period for the last couple of years, we went through a revenge concert cycle and getting back out into the real world cycle over the last 2 years. 2022 and 2023, everybody was cooped up in their homes and apartments and things like that. 2020, 2021, a lot of live events weren't even going on. So 2022 and 2023, people were just waiting to get out there, and they couldn't wait to go see their favorite musicians. They couldn't wait to go to the live events and all those sorts of things. That's a little played out now. And so now we're just kind of getting back into, in my opinion, a more normal demand environment, which could obviously weigh on ticket sales, especially given that, this isn't 2022 anymore when people were very flush with cash, when they hadn't already really been hit with inflation yet. Inflation really took its toll over the last 2 years, right? And so the consumer's in obviously a much weaker place than they were 24 months ago. Now, the problem with Live Nation is the government's after them big time. The U.S. Senate is starting to get fed up with Live Nation. U.S. government investigation of Live Nation. I mean, they just issued a subpoena back in November. A subpoena is something you're forced to basically respond to when the government's after you. So yeah, no bueno. This is not a good situation for Live Nation overall. I don't know how this ends, but I don't think it's going to end good. And look at this. Live Nation has stonewalled my subcommittee's inquiry into its abusive consumer practices, making the subpoena necessary, says the senator. So, I mean, the way he puts that there, it sounds like a verdict's already formed. Into its abusive consumer practices. That sounds pretty much like a verdict's already formed in this situation. And so I don't know where this is going to go for Live Nation, but I don't think it's going to be good because, they're not going to be able to show big profit. If they show huge profit increases while the government's after them, it's such a bad look, man. It's such a bad look. It's going to make the government even want to go after them even more, okay? So, and the Live Nation, I don't want to touch that one. If anything, I would be inclined to buy puts rather than go long, okay? Next one up here, JB.
Whether investor sentiment has just gotten too bullish. Let's ask Josh Brown. He's Ritholtz Wealth Management CEO and a CNBC contributor. He is with me here at Post 9. It's good to see you. Welcome back. You think that's the case? We got all bulled up because of the way we ended 23. We came in here and thought, hey, this could be smooth sailing. And maybe not so much.
Let me answer your question with a question.
Yeah.
Do you think the market goes up because people get bulled up? Or do people get bulled up because the market went up?
Well, the latter.
Okay, I agree with you. Why wouldn't investors be bulled up? Did you see the way that market ended last year?
Sure.
It literally ended like the 4th of July. It was picnics and watermelon and then fireworks. And I don't know if you were an investor, what more you could have wanted to see. The VIX was just vol smashed almost to zero and everything went up. Of course, people got bulled up. And that's quite all right. They should. I'd actually think there'd be something wrong if we had an S&P 500 finish the year up 25%, NASDAQ up 50%, and nobody was bullish. That would be problematic.
Yeah, but it's one thing to get all bulled up on July 4th. It's another thing to be all bulled up in March because you're waiting for the fireworks that may not go off yet because they're not supposed to go off yet. It's kind of what Jamie Dimon was talking about today out in Davos. I want you to listen to what he said about this idea.
I always listen to Jamie.
Market goes up and everybody gets bullish. Well, maybe that's a little too much. Listen.
I think it's a mistake to assume that everything's hunky-dory. And, and when stock markets are up, it's kind of like this little drug we all feel. Like, it's just great, But remember, we've had so much fiscal and monetary stimulation. So I'm a little more on the cautious side, that we are facing a lot of things in 24 or 25.
Maybe we're coming to grips with what we're facing. Maybe rates aren't going to be straight down. Inflation is not going to be straight down. Growth is going to be a little lumpy.
So I actually prefer my risk manager to speak the way that he does. I would be terrified if he were on the air saying, guns blazing, let's have another breakout year like we had last year. That's not what he's supposed to be doing, okay? This is the head of the largest deposit institution in the United States. It's a bulletproof bank. It should be a bulletproof bank, and the reason it is because Jamie Dimon is a risk manager first and foremost. That's his job. I'm glad that he's speaking that way. I hope most people are. That being said, what we're experiencing right now is exactly what you should expect after a rally as blisteringly hot as the one that we just had. So I want to walk you through a couple of things that we're looking at, and this is what we're talking to clients about. Okay. The first is the correlation between the VIX and the 10-year is at its highest level since 2018, back when the scariest thing in our lives was the trade war. Remember the trade war? That was fun. Okay. Anyway, the low point for this correlation was actually March of 2020 when it became apparent rates were going really low and not moving for a long time. Now we're back at a high of almost a 6-year high in that correlation. All that's telling us is that markets are getting a little bit shakier, but for the right reason. If you're seeing that 10-year note yield climb, it tells you that we are further away from the Fed looking to take policy down, and stocks don't love that, and that's perfectly fine. If we were selling off for any other reason, I would be singing a different tune, but that's really all that's changed. Nothing else has changed. We're back in an earnings season. So far, so good. The banks all had great things to say. We've got a lot further to go, but we are not experiencing a sell-off based on a risk to corporate profits. So it could happen. It's just not the story right now.
What about the idea that we may be too bulled up on sentiment? We may be too bulled up.
That's curing itself. It's curing itself.
The idea of all these interest rate cuts, and maybe most of all, that we're looking past a valuation that is stretched well beyond the historical average for all three of the majors, and that's what Aswath Damodaran yesterday, the so-called dean of valuation, said. The S&P's value overvalued in his mind by 9 to 10%.
But that has nothing to do with what's going on this year, and here's my proof. The worst performing sector, small caps, are the lowest valuation. So that is not what the issue is.
That's true.
Small caps are now down 6% on the year.
100%.
They finished the fourth quarter with a 14% rally. Almost all of it happened in the last 6 weeks of the year. It's a little bit of a give back.
100%. Now, does this mean small caps are doomed for this year? And the answer is absolutely not. Small caps still could have a great year. Russell could be up 20%, 30% by the end of the year. Obviously, Tom Lee's kind of in the 50 to 60% camp. I'm not that bullish on smalls, but don't count smalls out just yet for the year just because they got off to a rough start. That doesn't mean they can't, climb back immensely for the remainder of this year, okay? All right, guys, appreciate y'all joining me as always. Thanks so much for being here. If you're looking to apply to join my private stock group, get access to all my best courses, access to my 6 and 7 figure Discord chat, access to see how I build a portfolio, all those sorts of things. Check out the pinned comment down there. You fill out an application. We see if we can get you in there maybe this weekend or next week, all right? All right, guys, much love as always, and have a great day.